Mid-2018, my investment model gives about $832 per Tesla share, significantly higher than the price of Tesla at that time, which was hovering around $250 and $300 per share. In clear divergence with the popular belief that Tesla stock was significantly overvalued, my valuation was so high that my peers thought that there was something wrong with my investment model. Now, I understand model risk, but for some reason, I did not see any problem with my model. I rather believe that the argument presented for overvaluation was weak. Fast forward, we are in 2021. The share price has significantly appreciated in value, and I want you to understand that the current share is a fractional share, which is 1/5 of the initial share. So the share price has significantly appreciated in value, and I would like to provide an update to my views on Tesla. Ladies and gentlemen, welcome to The Analyst. In 2018, I made the following tweets on my Twitter account, still available on my page. I was then reacting to a wave of negative news around Tesla stock. These are the tweets that I made. First tweet: when so-called expert predicted downward pressure on Tesla stock, was that based on the deterioration of fundamentals? The answer is big no. Second tweet: but it seems like after that bearish look over the company by the so-called expert, we started witnessing an incredible attempt to undermine the company capability, as evidenced by the pressure of negative news over positive. Third tweet: are short sellers financing the negative news? A conspiracy told me so. And the last one: I am long on Tesla, and my emotionless metrics advise me to remain so. The argument presented for overvaluation were grouped in two camps. There was the camp believing or presenting the cash flow situation of the company as alarming enough to threaten the company viability and has the key element to justify overvaluation. I did not believe the argument was solid enough for a couple of reasons. The first, that the company is a young company. The company was a young company. In fact, Tesla was founded in 2003, and the first car produced, the Roadster, happened in 2009. For a company at that age, with a new technology that requires maturity, a technological maturity to mass produce car, investment is needed in research and development. And because the company does not mass produce at the early stage, the cost can be significant enough for the cash flow to be negative. This is not a situation that is unique to Tesla. It is a situation that is possible for a young company with a new technology. Second of all, the technology of Tesla, that Tesla brought to the market, had proven to be feasible. Had the technology not proven feasible, I mean in reaching the maturity that we require to mass produce car, I would have bought it. But this is not the case. That was not the case at that time. And lastly, the cash flow situation should be evaluated, taking into consideration not only the persistence of the situation, but also the age of the company. Now, we had the second camp. The second camp pointed to the demand saturation or demand cancellation for Model 3. I believe the argument was also weak for the simple reason that from my angle of analysis, Tesla has never had a demand problem. Tesla has had the production problem or the production efficiency problem. What do I mean by production efficiency problem? I mean the ability to mass produce car that can compete with existing alternative, or in other words, car that can be cheaper enough to cater for to customer with different budget. The company is still young, the technology has not yet reached maturity, and the car produced at that time catered just to a limited group of customer. So it was not the demand, the problem was not on the demand side. The problem is still not on the demand side. The problem is on the supply side. The ability to mass produce car that cater to the whole market. So those two arguments was not solid. But my evaluation of Tesla was different because it came from my experience running a business at some point. There are two key elements or things that I saw with Tesla, that I still see with Tesla, and that is very important in determining the value of the company. The first element is the customer satisfaction. Tesla is comparable to Apple in 2011. I mean the hysteria around the product. Most Tesla customers that I've seen are satisfied customers. They act like people in a cult. They love their product. They love their car. When a company is capable of having such customer, it is a very powerful tool. Nothing is more important than customer loyalty, for the simple reason that a happy customer is highly likely to come back and buy, and a happy customer is a free marketer for the company, because the happy customer will speak to the friends about the car, and the friends might come buy the car to experience what they've been told. So the second element is the manager's belief. If the manager believes in their technology, there is no reason why you should doubt the manager, especially when we have a manager as Elon Musk, who has proven to be a builder. Now, I usually follow a structure. First, I study the company profile, a bit of history about the company, what the company is really about. Then I move to key people. Who are the people behind the magic? What is their history? What have they done before? It's very important. It is a relation of trust. I'm gonna be giving my savings to them. So I want to know what they are capable of. After doing that, I move to the industry. What is the industry really about? My intention is to assess the profit pool. What is the money that is to be made? Now I move to key factors positively and negatively affecting the industry. After that, I move to the competitive structure. Determine what are the forces that are fighting for the profit pool that we're talking about. Now, for those of you who are not familiar with Tesla, it is important to say that Tesla, that is according to their public records, Tesla design, develop, manufacture, and sell high-performance fully electric vehicles. This is obviously their principal activity. However, Tesla also design, install, manufacture solar energy generation and energy storage product. The current CEO of the company is Elon Musk. Elon Musk, someone that we did not need to present, to introduce. I mean, the name, the achievement speaks for the man. But for those of you not familiar with his achievement, he co-founded X.com, which merged with Confinity in 2000 to form PayPal. He co-founded a defense company called Zip2. He is a founder of SpaceX. He co-founded Neuralink. He co-founded OpenAI. And he is the founder of the Borrowing Company. Now, moving to the industry, what is the industry really about? What is the profit pool that we are talking about? First of all, it is important to understand that the EV market, or the EV technology, if you want, comes as a solution to the existing technology, which is a problem when it comes to pollution. There has really been a global movement to shift to a safer technology, the technology that will help us to preserve the planet. Now, what does that mean? It means that at some point in the future, all the car available in, we're gonna say, in the world or in major market will be electric. So this is potentially a multi-trillion-dollar market. Now, what are the factors that are positively affecting the industry? So first, it is important to say that for the year 2020, the EV market has been the fastest growing market despite the pandemic, which saw a drop in global car sales. We are talking about 12 million electric vehicles existing in the world. And when we talk about EV market, there are really three types of cars. There is the battery electric vehicles, there is the plug-in hybrid electric vehicles, and the fuel cell electric vehicles. The trend shows that the future will be battery electric vehicle, fully battery electric vehicles. Now, the cost, the battery technology has been improving because the battery has been one of the key factors of the success of this market. The improvement of the battery technology is needed for the penetration to different models of car, and is also a key factor for the cost, for the acquisition cost. To be competitive, to compete with the existing technology, battery car will need to be cheaper enough to replace existing alternative. So the cost of the battery has been declining. In fact, the weighted average cost of automotive battery declined by 13% in 2020, and the trend is expected to increase. Now, the publicly accessible charger increased to 1.3 million in 2020. So apart from that, like I said, there is a global movement against pollution. There is an effort from major government around the world to lead the transition, and we've seen in major markets like China and Europe a government putting in place program to reduce the acquisition cost of EV cars. The private sector is also playing a significant role. In fact, most companies are going fully electric. There is also original equipment manufacturers. 18 out of 20 have committed to increase and offer to increase the offer and the sales of electric cars. One of the key factor is obviously the charging infrastructure. The charging infrastructure will need to expand significantly so that customer can charge their car wherever they are. It is going to be an important element to compete with existing technology and also to facilitate the penetration to other markets. Obviously, the support of the government around the world will be needed, and this is obviously something that needs to be watched carefully. Now, regarding the competitive structure, we know that existing direct competitors are NIO, General Motors, Aptiv, and Candid Technology. But looking at the competitive structure from a different angle, we can say that all existing car manufacturers will go fully electric at some point in the future. This will be forced by the legislation surrounding pollution and also by the need to survive.
White House, I'll be winning till I die.
So what is Tesla fair market value? To answer this question, I need the benchmark. So I created an investment model using more than 37 years of publicly available data. The model combines traditional price multiple with behavioral finance. The goal is to determine how financial market participants price the performance of a company over a 35-year period, which was the investment horizon that I chose. So using that benchmark data collected, I was able to produce the benchmark profit growth per year over 35-year period, the benchmark price growth, which is the price paid by financial market participants for that profit growth per year, the benchmark sales growth per year, and the benchmark cash flow growth per year over the 35-year horizon. What I can confidently say is that the trend growth in profit over a 35-year horizon is about 37.10%. And the price paid per year by financial market participants for that performance is about 20% increase in share price per year over the same investment horizon. The most important aspect when we invest is profit. We all invest for profit, and the company which generates more profit is supposed to be the most expensive company. So my goal is to determine how the subject company perform relative to the benchmark. Having that mindset, I was able to forecast key data for Tesla. the level of production needed per year to 2030, the sales per year, the profit per year, and the operating cash flow per share per year over the 10-year horizon. Here is the result, and here are the assumptions behind the data presented. I forecast the production to grow at about 40.33% per year to a capacity to produce about 14,800,000 cars in 2030. I forecast the cost of goods sold per unit of sales to gradually decrease and stabilize around 0.8. I forecast the operating cost per unit of gross profit to decrease to about 0.5. I forecast the average price of Tesla car to gradually decrease to about $49,000, and I forecast the global market share of Tesla to gradually increase to about 44%. Now, using this data, my model produces $433 as the price at which Tesla should be trading right now, which is obviously significantly below the current market price, which is hovering between $650 and $700, which I believe is the result of too much hype around the company. My model also predicts that in 2024, the company stock should be trading at around $1,361, provided that my forecasts are met. Obviously, the company will be able to justify a price higher than my model if the performance outperforms my forecast. So it is really a question of the holding period. I believe Tesla stock represents a good long-term investment, and I will define long-term investment as a minimum 4-year holding period. I do not believe this stock is good for a short-term investment, holding period of 1 to 2 years, because it is highly likely that the stock of the company will correct within this interval. So here is my update regarding Tesla. I believe it is very important to stress that I am not a financial advisor. This is just for educational purpose. So I hope you enjoyed my work, and if you did, please give it a thumbs up.